given that government debt to GDP ratio in the United States has already passed 100%. Before the pandemic, we were in the 75–80% range. So 100% is quite the marker. We really do believe that we're setting up for growth and particularly for innovation to take off again.
When all is said and done and the dust clears from the supply chain problems and everything, we're probably in a highly deflationary world.
Today, we got an employment report that was very weak relative to expectations. 235,000 increase in non-farm payrolls. The expectation, I think, was around 733,000. And last month, it was revised up to over 1 million. Now, we're trying to figure out, okay, what is happening here? Is it because of the Delta variant of the coronavirus and the pulling back of activity associated with that? Well, I guess this report corroborates that because leisure and hospitality employment was flat, and those numbers had been coming back very, very strongly until this month. So that's a probable reason. Is it because of supply chain issues? We're hearing about shortages, especially chip-related shortages, chips that go into everything manufacturing. Well, here too, we have some clues. Manufacturing hours worked were down 0.5%, which is a very big drop month to month. That's about 6% when you annualize it. So again, a big drop in a real indicator, not being influenced by inflation. Construction employment was also down. Again, there could be supply chain issues there.
If the whole world thinks that's going to happen, and a portfolio manager and analyst team thinks that's going to happen, well, if we're wrong, it's not going to matter that much, right? Because nobody's expecting it. It's not in the market. But if we're right, the returns are enormous. And I think that's what's going on with the technologically enabled innovation that we see, especially in healthcare, by the way. But there are two other sources of deflation. Disruptive innovation, there's another side to it. It's called creative destruction. And I think we're going to see more creative destruction than we have in all history during the next 5 to 10 years. Now, you can say, oh, you're just talking your book. We have rights law teaching us about learning curves and cost declines that suggest we are going to see incredible booms out there in parts of the world, but it's going to mean tremendous destruction in others. So when I say confusing, I mean that. And then the third source of deflation, I think, will be cyclical deflation. Most people are fighting us on this one. It's hard to fight us given our research on those other two. But this cyclical deflation, it started with lumber, $1,711 in May. Now we're at $500. Copper, $490. I think now we're at $425. Used car prices are surprisingly good, and I know we're getting pushback on this one too. They shot up 60% as everybody decided to avoid mass transit last year, right? And now we find ourselves supposedly in a chip shortage. I do believe in the chip shortage. Because
believe there's a chip shortage.
I do believe there's a chip shortage because the world's going digital. But I believe.
But wouldn't that be inflationary?
Well, I believe chips are the new commodities. That's the point I'm making here. So chips are going to be what Dr. Copper has been in the industrial world. This is Dr. Digital, I don't know, in the form of chips.
I think what's beginning to happen is consumers having bought a lot of cars in the last year to avoid mass transit, a lot of them being used. They're now sitting back and saying, okay, I've already got my car. So the inventory is not on the dealer lots. Many people were quick to tell me on Twitter that, couldn't I see the dealer lots are empty? Of course there's a chip shortage, but maybe the inventory is in the consumer's driveway or garage. That's one thing that we think could be the case. Or maybe consumers are saying, for my next purchase, given the total cost of ownership has come down and is now below where gas-powered vehicles are, maybe I will buy an electric vehicle. And so there could be a pause in auto buying because of the technology shift that is underway. I think we got a signal from Senator Manchin of West Virginia this week that he has a very important vote in the Senate, he thinks $3.5 trillion is just ridiculous, given that government debt to GDP ratio in the United States has already passed 100%. Before the pandemic, we were in the 75-80% range. So 100% is quite the marker. And he's also concerned about inflation and that a fiscal package of that magnitude might aggravate some of the inflation indicators that have been flashing red recently. I think that's a very good thing. If he is not for this package, it's not going to pass. I think he's much more for the $500 to $1 trillion pure infrastructure package. We really do believe that we're setting up for growth and particularly for innovation to take off again. Now, why are we saying this? Well, innovation solves problems, and we saw what happened in the coronavirus crisis. Innovation took off, and we've talked a lot about it, and we've moved into much more of a digital world much faster than otherwise would have been the case. Well, what are the problems now? Well, price increases are a problem, and consumers don't like them. So innovation does solve problems. I mentioned the electric vehicles. They're coming down in price, and they're better performing cars. They're better for the environment and so forth. So we believe the price decline associated with EVs is going to help solve the auto pricing problem. Cryptocurrencies have taken off as inflation fears have flamed. Crypto is a better hedge, Bitcoin in particular is a better hedge against inflation if that's the fear, than gold. Gold supplies will continue to increase over time as Bitcoin's supply starts to diminish in terms of the rate of increase.
All I know is when we are looking at the transformative growth that's going to take place in our space, and we're completely devoted to nothing else but disruptive innovation, we see explosive growth. I think one of the reasons they will look right in terms of GDP is if the other side of disruptive innovation is creative destruction, well, what's happening? It's the industrial world evolving into the digital world as more of the physical world goes digital, or transportation importantly, right? And so the traditional benchmarks, GDP, the statistics that we look like are probably going to look pretty lousy at